Welcome back to Investing Talk Podcast. Today, we are focusing our analysis on Datavault AI. The ticker is DVLT. Now, this company operates right in the thick of it, the AI data management sector. Super competitive, really fascinating space. And the big question we're tackling today is pretty straightforward. Based on what we're seeing, is this stock, DVLT, a good buy right now? Before we jump in, if you find this chat helpful, please do hit subscribe, like the video, maybe leave a comment. And hey, if there's a specific company you want us to dig into next time, just drop it in the comments below. Let us know. So we've gone through the recent financials, market reports, analyst notes, a usual drill, trying to piece together the drivers, the risks, the potential catalysts for Datavault AI. But quick reminder, super important, everything we discuss here, it's purely for informational and educational purposes. Okay. Definitely not trading advice. And the quotes we mentioned, they're based on available data, which, might have up to a 20-minute delay. Just keep that in mind. Okay, let's get into it. Datavault AI.
Well, it's showing those classic signs of a high-growth tech company just starting out. You see this big revenue expansion, but then whoosh, major spending right alongside it. On the growth side, the numbers, they do look pretty good. Trailing 12-month revenue reported at $4.4 million. And the full year 2024 revenue came in at $2.67 million. That's a pretty solid bump, up 28.4% year over year.
It is solid growth, yeah.
Yeah.
But like you said, you really have to look underneath that. You see the huge cost that comes with getting that market share. I mean, this isn't just a small loss we're talking about. Net losses, TTM, hit minus $68.6 million.
Wow.
And for 2024, it was minus $67.7 million. That's a jump of 170% in losses compared to the year before.
170% out.
Exactly. So, that huge spike in losses, it really confirms management is basically going all in. It's like a burn rate blitzkrieg. They're clearly prioritizing building infrastructure, grabbing market share, way over immediate profitability or solvency. The TTM earnings per share reflects this. It's negative $2.04. And there's no PE ratio published, which just confirms, they're in this super aggressive expansion phase, spend now, profit later. Maybe.
Those losses are definitely substantial, and that naturally makes you, the listener, think about the risk profile, right? But we did find something pretty interesting in the future projections, something that could maybe change the story here.
Absolutely. If you look ahead, the analyst coverage is still limited, but what's out there points to a potentially massive sequential jump in revenue for Q3 2025.
Mm-hmm.
The forecast, and okay, it's aggressive, I'll grant you that, suggests maybe a 200% sequential increase, or even 400% year over year.
400%.
Yeah. Now, if, and it's a big if that actually happens, that would be a major turning point for the whole investment story.
It definitely would change the conversation about the losses. But, is that realistic? Forecasting a 400% jump feels, incredibly optimistic. Are analysts pointing to specific contracts or milestones that make them think that's even possible?
Well, they seem to be linking it directly to the big capital raises, the ones we'll probably talk about later. The thinking is that money is turning into booked contracts and deployed infrastructure almost immediately. But you nailed the key issue. Until we see that November 14th earnings report, it's just a projection. And it requires, massive execution on their part.
Right. Okay, so let's shift a bit. If liquidity is a concern people are talking about, and we can't even see the free cash flow data publicly, how does management pull off this huge expansion, especially when the finances look, a bit shaky? And if they just brought in $150 million more in capital, isn't there a huge risk of dilution for people already holding the stock?
That's exactly the tightrope they're walking. And it's why we need to look closely at the structural fixes they've managed to pull off. Things that often get missed if you only look at the bottom line loss. The company has actually been working to improve its balance sheet, specifically converting some long-term notes. That helps reduce leverage, which is a positive step. But the really big moment, the crucial compliance catalyst, that was October 10th, 2025. That's when they officially got their Nasdaq compliance reaffirmed. They managed to keep the stock price above the $1 minimum bid rule for 10 straight days. Before they could even talk about massive growth, they had to prove they deserved to stay listed on the Nasdaq.
Okay, but why is that compliance thing such a big deal? It sounds kind of like technical paperwork.
Oh, it's much more than just paperwork. It's all about institutional access. Think about it. Without that compliance, big institutional funds, pension funds, ETFs, the players who can bring stability and long-term price support, they're legally blocked from even touching the stock.
Yeah.
So getting rid of that delisting risk, it basically opens the door for those institutions. It gives the company market credibility.
Okay, that makes a lot more sense. Institutional money needs those boxes ticked. Got it. So let's talk about their competitive edge, their moat. Datavault AI focuses on data sciences tech, using high-performance computing, HPC, and their own AI software. Sounds like they aren't just trying to be another generic cloud storage company.
Exactly right. They're trying to carve out a very specific niche,
Hmm.
focusing on things like secure data ownership, privacy, event analytics. These are all areas getting a huge boost from, well, everything going digital and this growing concern about data sovereignty. It's becoming really critical. And HPC, just for listeners who might not know, that means they're using specialized supercomputing power. It lets them handle really complex, massive data tasks much, much faster than regular servers.
And what about their tech itself? Is it protected?
That's another key point. Their intellectual property seems pretty solid. We noted the passage of something called the Genius Act. Now, this wasn't just some random legislative event. This validation is actually a huge competitive shield for them.
Yeah.
It essentially means the government has confirmed their key patents are legitimate. Things like their tech for secure, inaudible tone communications and some public safety applications. That makes it really tough for bigger competitors to just come in and challenge their core IP.
Okay, interesting. So they have a niche, some tech protection. Let's switch gears again, though, to the stock price itself, the technicals. Because, wow, this stock is not for the nervous investor. A 52-week range from 25 cents up to $3.10, that's wild. That's not investing. That feels more like a casino trip. How do you even begin to model risk on something that volatile?
Yeah, you basically have to treat it like a penny stock, but one with, big enterprise ambitions. That volatility. It's kind of the price you pay for the potential huge upside.
Yeah.
The stock closed recently around $1.70, which definitely reflects a lot of that uncertainty swirling around it.
Looking at the charts, it's a bit of a mixed bag, isn't it? Short-term moving averages seem to be giving a buy signal, maybe, but the long-term averages still firmly bearish, reflecting that big drop from the 52-week highs. Technically, it looks like the stock's hitting some resistance just above the $1.72 mark.
Right. And if it manages to break through that level, the recent momentum signals suggest the path could be clearer for a much bigger move upwards.
Yeah.
But what really stands out to me on the technical side and where there might be an opportunity is the 3-month MSOD indicator. It's currently signaling a potential bullish reversal. That's interesting. Plus, the relative strength index, the RSI, it's not screaming overbought yet. So there's theoretically room for it to run higher if some positive news hits next month.
Okay, potential reversal signal, room to run. But you have to weigh that against the risks, right?
Absolutely. You cannot ignore the high company-specific risks here. We're talking ongoing substantial losses, negative cash flow, huge execution risk related to those really aggressive expansion plans. And the reports even mention some continuity risk because of recent leadership changes. So, yeah, lots to worry about internally.
Makes sense.
But there's an interesting nuance on the market risk side. The company has a low beta, around 0.39, compared to the broader tech market.
Low beta. Remind us what that means simply.
Sure. So basically, it means the stock tends to move less dramatically than the overall market. It acts kind of like a shock absorber. If the Nasdaq drops, say, 10%, historically DVLT might only drop about 4%. So it offers some insulation from those big market swings. But, and this is crucial, its business risk, because of all those internal factors we just mentioned, remains incredibly high.
Okay, low market sensitivity, high internal risk. A tricky combo. We've hit the risk, the cash burn, the volatility. Now let's get to the really interesting part, this potential game changer. There's been a massive injection of positive news, potentially resetting their cash runway. Tell us about that huge $150 million capital raise.
Yeah, the big headline here was back in September 2025, this $150 million strategic investment from Celex Holding Company. I mean, that's not pocket change, that's serious growth fuel. And the first chunk, about $8.07 million, has already closed. That money is specifically tagged to speed up their supercomputing build-out and fund expansion of their data exchange, especially targeting the biotech sector.
Right.
And that capital infusion, it does more than just provide cash, it validates their model, particularly in a high-value sector like biotech. Getting Celex on board is a big deal. We should probably also mention they completed some closings on senior secured convertible notes back in August and September too, right before the Celex deal. So that provided some extra growth capital and financial flexibility just when they needed it.
Okay, so fresh capital, validation. This leads us right into the upcoming catalysts. Things that could move the stock in the near term, say the next 0 to 3 months. What should investors be watching?
First and foremost, it has to be the Q3 earnings release, right? November 14th, 2025. And given those aggressive forecasts we talked about earlier, expectations for strong year-over-year revenue growth are going to be sky high.
Absolutely critical date.
Right.
Miss those expectations, and it could get ugly. Beat them, and, well, that reversal signal might play out. Then, looking a bit further out, maybe December 2025, January 2026, keep an eye out for potential ETF index rebalancing and also the institutional holdings disclosures. Remember, we talked about institutional access. Early January is when we might see if big funds actually started buying after that Nasdaq compliance fix. That could really boost liquidity.
And this, of course, is where all the speculative buzz and rumors start flying around.
Oh.
Driven by the new cash and getting back on Nasdaq's good side. We should probably touch on some of these rumors, even though, they're just rumors at this point.
Yeah.
Highly speculative.
Yeah, what's at the chatter?
Well, one big one is the potential acquisition of a company called NYIAX.
Right.
That would supposedly give them a quick way into the ad tech and information exchange market, expand their commercial footprint fast. There are also these persistent rumors about a strategic partnership with a major biotech firm, directly tied, people think, to that Silex investment. That would be huge validation for their platform in biotech. And industry watchers are also looking for maybe a formal expansion of their existing partnership with IBM, focusing on the enterprise AI market. That could be another massive credibility boost. And looking even longer term, don't forget the backdrop. Continued expansion plans into Asia-Pacific and Europe, plus those big industry tailwinds like data security, privacy rules. Those are powerful multi-year drivers separate from any short-term rumors.
Okay, so bringing it all together, the risk, the growth, the cash, the catalysts. What's the final verdict for you, the learner listening in? We've weighed it all up, and we're giving Datavault AI an overall bullish rating, let's say 7.5 out of 10.
Yeah, 7.5 feels about right given the profile.
And the thinking behind that, for the more aggressive investor, it's pretty compelling, right? You've got that high revenue growth trajectory over 28% year over year. You've got the major strategic $150 million investment from Silex. Huge vote of confidence. The restored Nasdaq compliance, that's a massive structural fix, not just symbolic. Some constructive technical signals like that potential bullish MACD reversal we mentioned. And importantly, a strongly bullish analyst consensus out there with an average target price around $3. That suggests, what, 76% upside from where it is now?
It does. But defining the investment horizon is absolutely critical here. This is a highly speculative play, let's be clear. We really see two main paths for someone considering this. For the short-term trader, your focus is laser sharp on that November 14th earnings release. That's the main catalyst for potential rapid upside. If they hit or beat those high revenue forecasts, the stock could really run.
And for the long-term holder?
For the long-term investor, you're looking past the quarterly noise. You're focusing on the potential for wealth compounding as the business model hopefully matures. As they continue that global expansion, leveraging their niche in secure proprietary AI data management over, say, the next 3 to 5 years, it's a bet on the underlying business eventually catching up to the spending.
Makes sense. Two different approaches for two different types of investors.
But here's the final crucial question for anyone looking at this, regardless of their timeline. Given those huge losses and that big $150 million cash injection, the real question isn't just, will revenue keep growing? Yeah, who? The true measure of success, the thing that will really tell us if this works out, is how efficiently management deploys all that new capital.
Right.
Can they use it to shorten the runway to actual sustainable profitability, positive cash flow? That's the metric that will ultimately define whether DVLT turns into a great investment or just remains a high-stakes gamble.
Excellent point to end on. Efficiency of capital deployment is key. Okay, just one last time, we want to reiterate that this analysis, it's all for informational purposes only. It is definitely not investment advice. Please do your own research before making any investment decisions. All right, that's our take on Datavault AI for today. Thanks for tuning in. We'll catch you on the next Investing Talk podcast.